Welcome. In this video, we'll explore the common reasons why traders struggle and how to overcome them. Trading is often perceived as a path to wealth, but the reality is much different. Let's delve into the psychological and practical pitfalls that trip up many traders. Ever wondered why your trading account is shrinking faster than your patience? We're about to uncover the secrets of why traders fail and how to avoid joining the club.
Let's start by acknowledging a common misconception. Many new traders believe that mastering technical analysis is the key to success. While technical skills are important, they are often overshadowed by another crucial factor: psychology. Imagine this: you have a foolproof trading strategy, years of backtesting, and a deep understanding of market dynamics. Yet, you still lose money. Why? The answer often lies in the psychological traps that can derail even the most promising traders. So, you think you've cracked the code? You've learned all the fancy indicators, built your own trading bot, and even have a lucky pair of socks for trading days. But there's one thing you might be missing: your own mind. Many beginner traders enter the market with a lot of enthusiasm but often leave disheartened after experiencing losses. One of the main reasons for this is not a lack of technical skills or strategy, but rather the inability to manage the psychological aspects of trading. Let's dive into some of the most common psychological traps and how you can avoid them to become a more successful trader. Fear of missing out, FOMO. Let's talk about FOMO, or fear of missing out. This is a powerful emotion that can lead to impulsive trading decisions. When you see an asset skyrocketing, it's easy to feel like you're missing out on a golden opportunity. This can lead to buying at the top of a rally, which is often a recipe for disaster. Imagine you're watching a stock you've been following closely. It's been steadily climbing, and then suddenly, it takes off like a rocket. You feel a surge of adrenaline, a fear that if you don't buy in right now, you'll miss out on a massive profit. This feeling, my friends, is FOMO in action. FOMO is a powerful emotion in trading. It happens when you see a stock or asset rapidly rising, and you feel the urge to jump in late just because everyone else is. This often leads to entering trades at poor levels, where the risk of reversal is high. Why it's dangerous? You end up making emotional decisions, ignoring your strategy. How to avoid it? Stick to your plan and predefined entry/exit points. Remind yourself that opportunities in the market are endless. Chasing a missed trade could lead to a bad decision. Revenge trading. This occurs after a loss, where you try to win back the money immediately by placing irrational trades. Instead of accepting a loss, traders emotionally double down, hoping to recover quickly, often resulting in even bigger losses. Revenge trading is a dangerous trap that many traders fall into. After experiencing a loss, it's tempting to try to recoup those losses quickly. However, this often leads to impulsive decisions and further losses, creating a vicious cycle. Have you ever felt the urge to get back at the market after a losing trade? This is revenge trading, and it's driven by emotions like anger and frustration. While it might seem like a way to regain control, it usually ends up making things worse. Revenge trading. It's like trying to put out a fire with gasoline. You think you're going to get back at the market, but all you're doing is making things worse. Trust me, the market doesn't care about your feelings. Overconfidence after a win. After a string of successful trades, traders may feel invincible and start to ignore their risk management rules. They increase their position size without realizing that the market can turn at any moment. Success can be a double-edged sword. After a string of winning trades, it's easy to fall into the trap of overconfidence. This can lead to reckless risk-taking and ignoring the very rules that brought you success in the first place. Imagine this. You've been on a hot streak, your trading account is swelling, and you feel like you can't lose. This feeling of invincibility can be dangerous. It can lead to overconfidence and a disregard for risk management, which can quickly wipe out your gains. So, you are feeling like a trading god after a few winning trades? Well, I hate to burst your bubble, but the market doesn't care about your ego. Overconfidence can lead to reckless behavior, and that's a surefire way to turn a winning streak into a losing streak. Greed, holding on for too long. Sometimes, traders hold on to winning trades far too long, hoping for even bigger profits. Instead of taking profits at their target, they let greed take over and end up losing a significant portion of their gains when the market reverses. One of the most common mistakes traders make is holding on to winning trades for too long. Greed can blind us to exit signals, leading us to miss out on potential profits and even turn a winning trade into a losing one. Imagine this: you are in a winning trade, and the price is steadily rising. You start to think, just a little bit higher, and I'll have a huge profit. But what if the price starts to reverse? Holding on too long, driven by greed, can lead to disappointment and lost opportunities. We've all been there. You are sitting on a nice profit, and you think to yourself, just a few more pips, and I'll be a millionaire. But then the price starts to turn, and your dream of riches turns into a nightmare. Greed can be a powerful emotion, but it's really a good trading strategy. Holding on to losing trades. Many traders struggle with cutting their losses because it feels like admitting defeat. They hold on to losing trades for far too long, hoping the market will turn in their favor, which often results in deeper losses. Let's talk about one of the toughest aspects of trading: accepting losses. It's easy to get attached to a trade, hoping it will turn around. But clinging to losing positions can quickly erode your capital and derail your trading strategy. Imagine you're driving down a road and realize you've taken a wrong turn. Do you keep driving in the wrong direction, hoping you'll magically end up where you want to go? Or do you make a U-turn and find a better route? In trading, it's crucial to recognize when a trade isn't going your way and cut your losses before they spiral out of control. We all have that one friend who insists they can fix a broken appliance even though they've never touched a screwdriver. In trading, holding on to losing trades is like trying to fix a broken trade with wishful thinking. It's time to accept defeat and move on to the next opportunity. Conclusion: in trading, your mindset and emotions can be as critical as your technical analysis or strategy. By recognizing these common psychological traps, FOMO, revenge trading, overconfidence, greed, and refusing to accept losses, you can manage your emotions better and make more objective trading decisions. Always remember, successful trading is not just about big wins. It's about consistency, discipline, and emotional control. What psychological traps have you experienced in your trading journey? Share your experiences in the comments below, and let's learn together.